$5,065 per ounce. That is not a prediction from a fringe economist. That is not a headline from a gold bug newsletter. That is the closing price of gold on the London bullion market right now. A single troy ounce of metal, the same weight it has always been, now commands more dollars than at any moment in recorded financial history. And yet the mainstream press is treating this fact as a footnote, as a sidebar, as a curiosity buried beneath quarterly earnings reports and debates about interest rate timing. They are not telling you what this number actually means. They are not telling you who is buying, how much they are buying, or why they are buying with a speed and urgency that should be alarming every person on this planet who stores their wealth in US dollars. So let us talk about the number that the people in power do not want you to think about too carefully. 1 year ago, gold was trading at $2,300 per ounce. Today it sits at $5,065. That is a 120% gain in 12 months. Not a tech startup, not a leveraged ETF, not a speculative cryptocurrency. Gold, the asset that central bankers have been telling you is a barbarous relic since 1971. The asset they described as outdated, irrelevant, a museum piece in the era of digital finance. It just posted the single most explosive price run of its modern history, and the people who are paid to explain these things to you are completely silent about what is driving it. Bank of America, the fourth largest financial institution in the United States, has officially declared the beginning of what they are calling a gold supercycle. Their research note does not hedge. Their target is not $8,000 or $9,000. It is $10,000 per ounce. 10,000. That number is not from a conspiracy blog. It is from the official Global Commodities Research Desk of an institution that manages $3 trillion in assets. And the mathematical logic behind that target, when you trace it to its source, should change every calculation you have ever made about the safety of your dollar savings. Before we expose exactly what this supercycle means, why it is not a speculation but an arithmetic certainty, and how it is already destroying the purchasing power of your savings right now, please make sure you are subscribed to the channel so you do not miss the daily updates as this situation accelerates. And comment down below, gold or dollar? Which asset do you trust more right now? Tell us where you stand. The answers will tell us everything about how prepared this community is for what is coming. To understand what is actually driving the price of gold to $5,000, you have to understand one foundational truth about how this market actually works. Gold does not move because retail investors get nervous and pile in. Retail investors buy gold after it has already moved. They buy at the top, not at the bottom. Gold moves when sovereign money makes its decision. When central banks, institutions that manage the reserves of entire nations and employ the most sophisticated economists in the world, decide that the asset allocation of their country requires a fundamental change. These are not speculators. They are not momentum chasers. They are strategic allocators operating on generational time horizons. And right now, every major central bank outside of the Western dollar system is buying gold with a conviction and a speed that has no historical precedent in the modern era. The People's Bank of China has added to its official gold reserves for 15 consecutive months. 15 months without a single interruption. Through market volatility, through geopolitical shocks, through every quarterly cycle that might have offered a justification for pausing, they did not pause. They accelerated. That is not a hedge. That is not a tactical position. That is a strategic, irreversible, generational commitment to a single thesis. The US dollar's role as the world's reserve currency is in terminal decline, and the future belongs to those who are holding real assets when the transition completes. And China is not alone. According to World Gold Council data, global central bank gold purchases in 2025 exceeded every previous year in the institution's 75-year history of tracking this data. The record was set, and then it was broken again. The nations of the world, not the citizens, not the retail investors, not the hedge funds, the sovereign wealth managers of nation-states are moving out of dollars and into gold at the fastest pace ever recorded. No one in the mainstream financial media is connecting this data point to the $5,000 gold price. But the connection is not subtle, it is arithmetic. The gold supercycle is not a new concept. There have been two major supercycles in the modern era of fiat currency, and each one was triggered by a fundamental fracture in the prevailing monetary order. The first ran from 1971 to 1980. Gold went from $35 to $850 per ounce, a 2,300% move driven by the collapse of the Bretton Woods gold standard and the dawn of the pure fiat currency era. The second ran from 2001 to 2011. Gold went from $250 to $1,920, a 670% move driven by the dot-com collapse, the global war on terror, and the early tremors of the sovereign debt crisis in Europe. Every supercycle in gold has been triggered by the same underlying condition, a moment when the foundational assumptions of the global monetary system were publicly and irreversibly revealed to be fraudulent. A moment when enough people in enough powerful positions simultaneously concluded that the current monetary order could not survive in its present form. Bank of America is telling us we are now entering the third supercycle. And the trigger this time is not a policy shift or a single geopolitical shock. The trigger is the simultaneous, coordinated, openly acknowledged abandonment of the dollar-centric financial system by the nations that collectively represent more than half of global GDP. This is not a cycle. This is a rupture. Here is how the underlying mechanics work, because the people who protect their wealth in times like these are the people who understand the plumbing, not just the headlines. For 50 years, the global monetary system has operated on what economists call the petrodollar standard. When any country in the world needed to buy oil, the fundamental energy input of industrial civilization, that transaction had to be settled in US dollars. This created an enormous, permanent, structural demand for dollars from every economy on the planet. And the countries that exported oil received dollars which they recycled back into US Treasury bonds. Saudi Arabia, Kuwait, the UAE. The petrodollar recycling mechanism created an artificial bid for American government debt that allowed Washington to borrow at artificially low interest rates for half a century. This system is now breaking apart in real time. China, the world's largest oil importer, consuming roughly 15 million barrels per day, is now settling a rapidly growing share of its energy purchases in Chinese yuan. Saudi Arabia, breaking with the explicit terms of the original petrodollar agreement that Henry Kissinger negotiated in 1974, has publicly confirmed it will accept currencies other than the dollar for oil exports. Russia, currently one of the top 3 oil producers on the planet, is selling the majority of its oil to India and China in bilateral currency arrangements that entirely bypass the dollar system. The infrastructure of the petrodollar, the mechanism that created 50 years of artificial demand for American IOUs, is being systematically dismantled by the largest producers and consumers of energy in the world. But the story does not stop there, because the petrodollar breakdown is only one front of a multi-dimensional assault on the dollar's reserve status. The second front is the weaponization of the dollar itself. In February of 2022, the United States government, in coordination with its European allies, froze the Russian central bank's foreign currency reserves, approximately $280 billion of assets that Russia had accumulated over decades through trade surplus. In a single executive action, those reserves were rendered inaccessible. Not seized, not confiscated, frozen, effectively removed from Russia's control as a punitive measure for the invasion of Ukraine. Every central bank in the world watched that action, and every central bank in the world asked itself the same silent question. What is the legal and practical difference between Russia's situation and our own? If the United States can freeze the reserves of a G20 economy with a signature on an executive order, what protection do any of us have? The answer, of course, is none. The dollar is not neutral. It never was neutral. But until 2022, the pretense of neutrality was maintained well enough that most nations were willing to hold their savings in it. That pretense is now gone. The dollar has been openly used as a weapon of state, and every nation that is not a close ally of the United States, which represents the majority of the world's population and a very large share of global GDP, has now concluded that holding dollars means holding an asset that can be weaponized against them at any time for any reason. And here is where it gets worse. Much worse. Because the response to the Russian reserve freeze was not a nervous reshuffling of portfolios. It was a generational, strategic decision to build an entirely different monetary architecture. The BRICS nations, Brazil, Russia, India, China, South Africa, and their new members including Iran, Ethiopia, Egypt, and the United Arab Emirates, are constructing payment infrastructure specifically designed to eliminate dollar dependency. They are building settlement systems, correspondent banking networks, and trade finance mechanisms that operate entirely outside of SWIFT, entirely outside of the dollar clearing system, and entirely outside of American jurisdictional reach. This is not a marginal project. This is the deliberate engineering of a parallel financial system covering economies that collectively produce 36% of global GDP at market exchange rates, and more than 45% at purchasing power parity. When this infrastructure is operational, the structural demand for dollars in international trade will fall dramatically. And when the structural demand for dollars falls, the value of the dollars you hold in your savings account falls with it. But the real danger lies one layer deeper, because the structural dollar exit is not just about trade. It is about what nations choose to hold as reserves after they stop holding dollars. And here is the critical insight that Bank of America's research captures with the $10,000 price target. There is no other liquid, neutral reserve asset on the planet that can absorb the reallocation of $7.4 trillion in foreign-held US dollar reserves. The euro has its own structural problems. 11 countries with vastly different fiscal positions sharing a single currency with no unified debt backstop. The yen is being destroyed by Bank of Japan yield curve control and a debt-to-GDP ratio of 260% that makes Japanese fiscal sustainability more fiction than fact. The renminbi is not freely convertible and will not be for decades given China's capital account structure. There is no substitute for the dollar that works as a reserve currency, except one. Gold is the only internationally recognized, completely neutral, unfreezable, undebasable store of value that has existed for 5,000 years of monetary history. It has no issuer that can be sanctioned. It has no counterparty that can default. It cannot be inflated by a printing press or frozen by an executive order. When the dollar is revealed to be inadequate as a reserve asset, there is one and only one destination for the capital that needs to leave: gold. The demand surge is not a trading thesis. It is a structural inevitability driven by the exhaustion of alternatives. And this brings us to the most terrifying part for anyone who stores their financial security in dollar-denominated accounts. The supply of gold is fixed by geology. The global mining industry produces approximately 3,500 tons of gold per year. That number cannot be meaningfully changed in the short term because developing a new gold mine takes 7 to 10 years from discovery to production. Central bank demand alone consumed over 1,200 tons of that supply in 2025. Add jewelry demand from India and China, two civilizations with 4,000-year cultural commitments to gold as the foundation of real wealth. Add Western investment demand from people who are finally reading the same data that central bank reserve managers are reading, and total demand has structurally exceeded total supply. In a market where demand exceeds supply and the primary buyers are sovereign institutions with no price sensitivity, the price does not stabilize. The price rises until it reaches a level where equilibrium is forced by some external factor. But there is no price level at which China's central bank decides it has bought enough gold. There is only a strategic mandate that says reduce dollar exposure, increase gold exposure, period. We need to talk about the physical gold market because what is happening there is even more alarming than the headline price. And almost no one in the financial press is covering it properly. The gold price that you see on your screen is set by paper markets. The London Bullion Market Association and the COMEX Futures Exchange in New York trade paper contracts. Claims on gold, not physical gold itself. For every 100 ounces of gold exposure that trades on these markets, there is less than 1 ounce of actual physical metal standing behind it. For decades, this system worked because the vast majority of paper gold holders never demanded physical delivery. They were content to roll their contracts and collect the price exposure without ever taking possession of actual bars. But as central banks buy gold, they demand physical delivery. They specifically require the bars to be shipped from custodial vaults in London and New York to their own vaults in Beijing and Mumbai and Ankara. The People's Bank of China is not holding its gold reserves in a JP Morgan vault in Lower Manhattan. The bars are being shipped to China. India recently repatriated over 100 tons of gold from the Bank of England, a deliberate, symbolic act of severing the custodial relationship with the Western financial system. Turkey has been a systematic repatriator for years. The physical gold is leaving the Western custodial system permanently. It is being moved behind borders that are outside of U.S. jurisdictional reach. And as the physical inventory in Western vaults shrinks, while the paper claims against that inventory remain enormous, the paper gold market is developing a structural credibility problem. We have already seen the early signs of physical market stress. COMEX delivery requests at elevated levels, LBMA lease rates spiking, premiums in the physical market diverging from the spot price. When the bifurcation between paper gold and physical gold reaches a critical point, the paper price will need to reprice dramatically higher to reflect actual physical scarcity. That repricing event, combined with the monetary demand from sovereign reserve diversification, is the mathematical foundation of the Bank of America $10,000 target. It is not speculation. It is supply and demand arithmetic in a market where the primary buyers have unlimited sovereign balance sheets and the primary sellers are geology-constrained mines. There is another dimension of this crisis that requires your attention because it connects the gold supercycle directly to the solvency of the financial system that holds your savings. The United States government is running a structural deficit of $2 trillion per year. It needs to borrow $2 trillion every single 12 months just to cover the gap between its spending and its tax revenue. To borrow that money, it must sell treasury bonds at weekly auctions, a permanent, unrelenting parade of debt issuance that requires a permanent, unrelenting stream of buyers willing to lend money to a government that has explicitly demonstrated its inability to live within its means. For 50 years, those buyers were foreign central banks, primarily China and Japan, who recycled their trade surpluses back into American debt. Japan alone currently holds over $1 trillion in U.S. treasuries. But Japan is now in a structural bind. The Bank of Japan has spent 2 years defending a zero interest rate policy in a country with 4% inflation. That defense requires selling dollars and buying yen, exactly the opposite of recycling trade surplus into U.S. debt. Japan has gone from being a reliable buyer of American bonds to being a potential seller. China has already crossed that threshold. The official Chinese holdings of U.S. treasuries have fallen from over $1.3 trillion at peak to below $760 billion and still falling. Every month, China is not just declining to buy new bonds, it is selling existing ones into the secondary market. The Federal Reserve, which absorbed trillions of dollars in treasury supply during the pandemic through its quantitative easing program, is currently in quantitative tightening mode, shrinking its balance sheet, selling bonds onto the market, adding supply rather than absorbing it. U.S. commercial banks are already sitting on over $600 billion in unrealized losses on their existing bond portfolios according to FDIC data. They cannot buy more bonds without amplifying those losses. The domestic retail investor does not have the balance sheet capacity to absorb $2 trillion per year in new government debt issuance, on top of the existing supply being dumped by foreign sellers. The math is producing a supply-demand imbalance in the treasury market that is unsustainable, and the market is responding exactly as it should, by pushing yields higher to attract whatever marginal buyers remain. But higher yields create a brutal feedback loop for a government that owes $36 trillion. Every 1 percentage point increase in the average borrowing cost adds $360 billion to the annual interest bill. The interest expense has already become the single largest line item in the federal budget, exceeding the defense budget for the first time in American history. If yields normalize toward historical averages of 6 or 7%, the interest bill mathematically consumes the entirety of federal tax revenue. At that point, the government must either default or print. History tells us with perfect consistency which choice governments make. They print. They choose inflation over explicit default because inflation is a silent tax. It destroys the purchasing power of savers without requiring a formal announcement of insolvency. And the moment the Federal Reserve is forced to restart large-scale bond purchases to monetize the debt that foreign buyers no longer want, the dollar enters a phase of deliberate, managed debasement. In that scenario, every dollar you save today is worth less every day. And every ounce of gold that central banks have already purchased at 2,000, 3,000, 4,000, 5,000 becomes worth more. This is not a prediction. It is a mathematical certainty written into the fiscal structure of the U.S. government. The contracts say the interest is due. The balance sheets say there is no one left to buy the bonds. The Fed will print, the dollar will fall, gold will rise. The sequence is locked in. Now let us talk about what this means for you, not for emerging market central banks, not for sovereign wealth funds, for you, for the dollars sitting in your savings account right now, for your retirement portfolio, for the purchasing power of the labor you exchange your life for every working day. Your bank account is not a vault. It is an unsecured loan to a leveraged financial institution that holds its assets primarily in the same dollar-denominated instruments that are being sold by the world's largest creditors. When you deposit money in a bank, you are not storing your money. You are lending it to the bank, which then invests it in bonds, loans, and other financial instruments. If those instruments lose value, and they are currently losing value as bond yields rise, the bank is sitting on losses. The FDIC currently reports over $600 billion in unrealized losses on bank balance sheets across the United States. $600 billion of losses that exist right now, hidden by accounting rules that allow banks to avoid marking their assets to market as long as they can claim they intend to hold them to maturity. This is a strategy that Wall Street insiders call extend and pretend, a dangerous game of delay in which financial institutions avoid recognizing losses, hoping that conditions will improve before they are forced to sell. Silicon Valley Bank played this game in 2023 and lost. When depositors started withdrawing money faster than expected, the bank was forced to sell bonds at a loss, crystallizing the unrealized losses into actual insolvency in a matter of hours. That was a single regional bank. The same dynamic exists across the entire system at a scale that the FDIC's insurance fund cannot cover. The Dodd-Frank Act, passed after the 2008 financial crisis, contains provisions for what is legally called a bail-in. A bail-in is the process by which failing bank losses are covered not by a taxpayer bailout, but by converting depositor account balances into bank equity shares. This is not a conspiracy theory. This is federal statute law that is currently on the books. In Cyprus in 2013, depositors with accounts over 100,000 euros had a portion of their savings forcibly converted into shares of a failing bank. The legislation exists in the United States. The legal framework for confiscating a portion of your savings to recapitalize a failing institution is already written and enacted. Most people have no idea it exists. The FDIC Insurance Fund holds reserves equal to approximately 1% of total insured deposits. In a localized bank failure, this is sufficient. In a systemic event, a wave of bank failures driven by a bond market dislocation caused by the foreign selling we have described, the fund is exhausted almost immediately. The FDIC would then require a congressional appropriation, which in practice means the Federal Reserve prints the money to cover the losses, which further debases the dollar, which further accelerates the move out of dollars, which further pressures banks. The circle is vicious and it is tightening. You are paying the monetary debasement tax whether you realize it or not. Every time the Federal Reserve expands its balance sheet, every time the Treasury Department issues new debt, the supply of dollars increases and the value of each existing dollar decreases. You work for dollars. You save in dollars. But the government creates dollars for free, diluting your labor with every keystroke. The $5,000 gold price is the market's way of telling you exactly how much that dilution has accumulated. Gold has not gone up 120% in a year. The dollar has gone down 120% relative to the hardest form of money that exists. Your savings account has lost 120% of its gold-denominated purchasing power while you were earning 2% annual interest. The math of that loss is devastating. The window is narrow and it is closing. Do not be the last person standing outside the bank on Monday morning when the news breaks. The institutions that know what is happening are moving right now. The Chinese central bank is buying. The Indian central bank is buying. The Turkish central bank is buying. The Russian National Wealth Fund is buying. Bank of America has published the research. The World Gold Council has published the data. The signal is not hidden. It is being broadcast loudly by the behavior of the most sophisticated monetary institutions on the planet. The only question is whether you choose to act on it while the door is still open. Here is what you can do right now. Not next month, not after the next Fed meeting. Now. Step 1. Begin allocating a meaningful portion of your liquid savings to physical gold. Not a gold exchange traded fund, not a futures contract. Physical gold, bars or coins, held either in your personal possession or in an allocated and segregated storage account where the specific bars are titled directly to you. The distinction between allocated and unallocated storage is the difference between owning gold and owning a claim on gold held by a bank. In a systemic crisis, those are not the same thing. An allocated segregated account means your bars cannot be claimed by the custodian's creditors in a bankruptcy. Start with 5 to 10% of your liquid net worth. The point is to start now, not to time the perfect entry. Step 2. Exit long-duration U.S. Treasury bonds from your investment portfolio entirely. A 10-year Treasury bond yielding 4.5% in an environment of 7 to 10% real monetary inflation is a guaranteed wealth destruction machine. The nominal yield does not compensate for the purchasing power erosion you are absorbing. Holding U.S. government bonds today is not risk-free return. It is return-free risk. A mathematically programmed loss of purchasing power dressed up as a conservative investment. Step 3. Reduce your concentrated cash position in U.S. dollar accounts beyond your immediate operating needs. The holding cost of excess cash is not zero. It is the full rate of monetary inflation, a guaranteed negative real return. International diversification of currency exposure through assets denominated in the currencies of commodity exporting nations or through direct commodity ownership is a structural hedge against the debasement that is already underway and accelerating. Step 4. Investigate gold royalty and streaming companies as a leverage vehicle for the supercycle. These companies own contractual rights to receive a fixed percentage of production from gold mines without bearing the labor costs, energy costs, or capital expenditure of actually running a mine. When the gold price goes from $5,000 to $10,000 per ounce, a royalty company with fixed cost production rights captures the entire price increase as margin expansion. This is operational leverage to the gold price that physical metal ownership alone cannot provide. Step 5. Have a transparent conversation about your portfolio structure with an independent, fee-only financial advisor who is not compensated on commission from financial products. The standard financial planning industry has a structural incentive to keep your capital in the instruments that generate their fee revenue, stocks, bonds, and managed funds. An independent advisor with experience in commodity cycles and monetary history will give you an honest accounting of your real exposure to dollar debasement risk and a realistic framework for managing it before the transition accelerates. You have the information. You have the data. You have the institutional confirmation from Bank of America, from the World Gold Council, from 15 consecutive months of People's Bank of China gold accumulation, from the record-setting central bank gold purchases of 2025. The 120% price increase in 12 months is not noise. It is the market's message to every dollar saver on the planet, written by the most informed buyers in the world, in the hardest asset that has ever existed. $10,000 is not a destination. It is a milestone on a longer journey whose endpoint is a new global monetary order. The nations that hold the most gold when that order is negotiated will write its terms. China is positioning for that negotiation right now. Russia is positioning for it. India is positioning for it. Wealth is never destroyed. It is merely transferred from those who are unprepared to those who are positioned. The transfer is already underway. The $5,000 price is not the beginning of the supercycle. It is the confirmation that the supercycle has already started, and that the most dangerous thing you can do is wait. Knowledge is your armor in this transition. Preparation is your shield. The supercycle is not a theory. It is $5,065 per ounce, rising toward $10,000, written in the only language that financial markets speak without lying, the language of actual capital allocation by the most powerful institutions on Earth. Subscribe to the channel and turn on the notification bell so you are alerted the moment the next major development in this gold supercycle breaks. We will track the central bank purchase data, the COMEX physical delivery statistics, the LBMA lease rates, and every geopolitical development that connects to the monetary transition in real time. Share this video with anyone in your life who still believes that a dollar savings account is a secure place to hold wealth. You may be the person who changes the trajectory of their financial future.